Welcome back to Taxinator. This is in continuation to our video on CFC and its implementation in Pakistan. If you haven't watched the first part, it is advisable to watch that first to better understand the concept. The part 1 of the series was to explain the basic concept of the Controlled Foreign Company regime. In this part, we will explain how it has been implemented in Pakistan. As mentioned in the first video, Pakistan is new to the concept of CFC, which has been recently incorporated through the Finance Act 2018 by inserting Section 109A of the Income Tax Ordinance 2001. The board has also issued a circular number 13 dated 20th August 2019. This video is attempted to cover the concept as envisaged in the law and the circular. Let's first enlighten on the definition of CFC under the Income Tax Ordinance 2001. What constitutes a CFC? A non-resident company incorporated in any other country or jurisdiction is evaluated whether it's a CFC or not. So the first criteria is the element of control, that is, shareholding in that non-resident company by a resident person in Pakistan. To clarify here, the control includes both direct and indirect control through voting rights or shareholding, where direct means direct ownership of capital or voting rights, and indirect control includes ownership through subsidiary companies or companies in which the resident person exercises control through ownership of capital or voting rights, so definition here is wide. The law sets two standards for identifying control. First one is where 50% or more shareholding is held by one or more resident person in Pakistan. Or the second criteria is where 40% or more shareholding is held by a single resident person in Pakistan. The difference here, apart from the percentage holding, is the number of persons having that control. It is either one person with 40% shareholding or 50% shareholding with one or more persons. Let's try to explain it through an example. For instance, there's 45% shareholding in a non-resident company held by two persons, A and B, where A holds 25% holding and B holds 20%. Here, none of the condition is fulfilled, then total holding is less than 50% and neither of them holds 40% holding, so it's not a CFC. In this similar example, if A held 5% and B held 40% shares, then it will constitute a CFC. Since B holds 40% holding, it squarely falls under the lexicon and hence a CFC. Take another example, where A and B hold 25% holding each, total of 50% holding in the non-resident company. It will constitute a CFC since 50% shareholding is held by one or more resident persons. A single person holding 35% control would not constitute a CFC, as it has to be at least 40% control to qualify as a CFC. This is how control thresholds are set to capture significantly controlled offshore companies by Pakistanis. Subsidiaries of CFCs shall also be assessed under the same criteria in which there is significant control of resident company. For example, if Company A in Pakistan owns 50% shares in Company X in UAE, and Company X has a subsidiary, Company Y, in UK and owns 80% of its shares. With 50% shares in Company X, it qualifies as CFC of Company A. In case of Company Y, Company A has effective control of 40% in the Company Y. Therefore, it shall also constitute CFC of Company A. And similar example, where if Company X had 70% shareholding in Company Y, then Company A shall bear effective control of 35% in Company Y, in which case Company X shall be CFC, but Company Y shall not be treated as CFC of Company A. So the effective control of subsidiaries is the key point here. Let's move on to the second criteria. The second criteria is the corporate tax rate. As explained in the first part, the aim of the regime is to eradicate base erosion and profit shifting to tax havens or low tax jurisdictions, which avail no tax or less tax benefits, reducing their overall tax bill. The law says that a non-resident company shall not be treated as CFC if the tax paid outside Pakistan by the non-resident company is less than 60% of that tax that would have been paid in Pakistan under Pakistan's tax law. To explain this provision, let's take an example of non-resident company declaring income during foreign tax year amounting to rupees 6 million. Taking the figures in Pakistani currency for ease, and that company paid corporate tax in the jurisdiction where it resides amounting to rupees 1 million. The law then takes into account any foreign tax credit available to the non-resident company. In this case, let's say rupees 200,000. Total tax paid in foreign country adds up to rupees 1.2 million. Now, normal corporate tax rate as applicable in Pakistan is 29% for the corporations. The tax liability of the said income in Pakistan would have been rupees 1.74 million. So 60% of the tax payable in Pakistan works out at rupees 1.044 million. As the tax paid by the non-resident company is higher than 60% of tax that would have been payable under the law in Pakistan, the said non-resident company is not a CFC. So effectively, any company in jurisdiction with corporate rate lower than 17.4%, that is 60% of 29% corporate tax rate in Pakistan, would normally qualify as CFC in Pakistan. However, the calculation of income under the Pakistan law may suggest otherwise. Let's move on to the third criteria, which is basically an exclusion from CFC definition. That is where non-resident company earns active business income significantly. Active business income here is basically associated to genuine business undertaken in any jurisdiction with economic ties, which can be trading, services, manufacturing activity or so. So it can be termed as income from business, which is genuinely attached to the economic ties of that country or jurisdiction. The law stipulates that a non-resident company shall be treated to derive active income if more than 80% of total income does not include passive income, which includes dividend income, interest, property and capital gains, royalty, annuity payments, sale services to associates, sale or licensing of IP, that is intellectual property, and management, holding or investment in securities and financial assets. To better understand this formula, let's take example of scenario A, where a non-resident company earns dividend income amounting to rupees 600,000, rental income amounting to rupees 800,000, and trading income of rupees 6.5 million. The total income works out at rupees 7.9 million. In this case, the active business income is 82%, which is higher than the threshold. In this scenario, the non-resident company shall not be constituted as CFC and shall be excluded from the regime. In contrast, if in scenario B, a non-resident company earns dividend income amounting to rupees 3.9 million, rental income amounting to 2.4 million, and trading income of rupees 1.5 million, the total works out the same of rupees 7.9 million. In this case, the active business income is 19%, which means 81% of the income of the non-resident company is passive income. So the non-resident company shall fall under the CFC regime and shall be taxable accordingly. Further, the regime also provides with another outright exclusion, which is for non-resident company that is listed. A non-resident company is not a CFC if shares of that non-resident company are traded in a stock exchange which is duly recognized by the country in which it operates. So the law gives 4 basic filters to establish whether a foreign company is a CFC or not. That is, shareholding or control of shareholders in the foreign corporation, threshold of corporate tax rate, active business income, and listed corporations. After identifying the CFCs, the next question is that what will be taxed under the CFC regime? To understand, let's take an example of a non-resident company situated in UAE which qualifies as CFC under the law. For instance, that company has earned income during a tax year amounting to 869,565 AED, which applying the exchange rate works out to 40 million rupees in Pakistan. The principle under these figures is that the income of the CFC, the company, that is the non-resident company, shall be computed as per the provisions of the Income Tax Ordinance 2001, as if the non-resident company is actually a resident company in Pakistan. Thereby, for deriving the income of CFC, all the provisions for computation of taxable income under the Income Tax Ordinance 2001 shall apply. Secondly, the conversion rate shall be applied at the State Bank of Pakistan rate as on the last day of the tax year, that is the 30th June, as for the normal tax year. Now let's assume shareholding or voting rights of resident person, who is one of the shareholders, has 20% shares in the non-resident company. Then income of the resident person shall be attributed to the shareholding rate, that is 20% of 40 million, which is rupees 8 million. So attribution of income is based on the formula of income of CFC multiplied by percentage shareholding or voting rights of the resident person. That way, the attributed income, that is rupees 8 million in this case, shall be subject to 15% rate of tax, which works out at rupees 1.2 million, as if the same is dividend income under the Pakistan tax law. On this stage, the law provides another exclusion clause. That is, if income of CFC in Pakistan currency for a shareholder is less than rupees 10 million, then the CFC income shall be treated as zero. To clarify, this exclusion is not for determination of CFC, because the CFC shall remain a CFC in this case, but law provides a minimum threshold for taxability of income and treats any income below 10 million as nil, therefore no tax in that case. A second exclusion on voting rights is also provided under the law. Where voting rights or shareholding of a resident person is less than 10% in a CFC, then attributable income shall be treated as zero in that case as well. These two provisions basically establish materiality principle, where low-value shareholders are excluded from the hardship of CFC regime. This, however, can create venues for tax engineering, where a CFC can be established by a group of people in Pakistan with total shareholding in a foreign company qualifying for CFC, but each shareholder owns less than 10% voting rights or shareholding. Thereby, the whole group can avoid CFC tax. Let's discuss the income attribution in case of subsidiaries. Company A in Pakistan has shareholding in Company X in UAE to the tune of 50%, and Company X holds shareholding in Company Y situated in UK with 80% shareholding. Let's assume Company X earns income in a tax year amounting to $1 million and the subsidiary Company Y earns income of $1 million as well in the said tax year. It has to be established first that the income of Company X does not include dividend from Company Y, and if there is so, the same shall be excluded to avoid double taxation. In this scenario, the attributable income for Company A in Company X works out at $0.5 million with 50% shareholding, whereas in case of Company Y, with $1 million income multiplied by 80% shareholding of Company X and then multiplied by 50% shareholding of Company A, works out at $0.4 million. The total attribution for these both CFCs will work out at $0.9 million US. This is how the income shall be taxed under the CFC regime in case of subsidiaries. Next step is when the income is actually received in Pakistan from the CFC in the form of dividend. Let's assume a resident person in Pakistan has shareholding in a CFC in UAE which earns income, and the resident person pays tax in Pakistan through the CFC regime as dividend income, but the same has not yet been received in Pakistan. When the dividend income is eventually received in future by the resident person from that CFC, it shall be exempt from tax and no double taxation arises. But this exemption is to the extent of income taxed under the CFC regime. To explain this, let's take an example in comparative tax years. In tax year 2020, attributable income is Rs 50 million and actual distribution of Rs 20 million take place. In tax year 2021, attributable income is 10 million and actual distribution of the income is nil. In tax year 2022, attributable income is Rs 20 million and the actual distribution of profit is Rs 10 million. And lastly, in tax year 2023, attributable income is Rs 30 million and actual distribution is nil. As we can see from the chart, the paid amount under the CFC regime shall be accounted for throughout the years, and where actual disbursement of dividend exceeds the amount already taxed, the difference shall be taxed accordingly. For instance, in the year 2020, as a parent, the amount taxed under CFC is Rs 15 million, whereas the dividend received is Rs 20 million. So 15 million shall be exempt from tax as already paid under the CFC regime, and the differential 5 million shall be taxable in that very year. That is how a resident person shall be required to maintain the account updated and offer tax accordingly, and avoids double incidence of taxation. The last and the important element of the regime is foreign tax paid. This foreign tax paid pertains to any tax that has been deducted by the CFC on distributing dividend income to the resident person. The law allows foreign tax credit in the year in which actual dividend is received and shall be allowed lesser of actual foreign tax paid and Pakistan tax payable on the dividend received. This is a general rule where tax credit is allowed only to the extent of liability that arises in the jurisdiction which allows foreign tax credit. Any excess tax paid in any other jurisdiction would not be credited. However, treaty benefit wherever applicable shall apply with lower tax deductions on dividend payments. In order to understand the analogy of the foreign tax credit, let's take an example with comparative tax years. Where in year 2020, attributable income of a CFC is Rs 8 million, which is taxed under the CFC regime at Rs 1.2 million. In this year, the resident person shall be required to pay the said amount without any tax credit. In the next year, 2021, attributable income is Rs 2 million and tax under CFC regime works out at Rs 300,000. Further, a dividend is also received to the tune of Rs 3 million during the year and tax is deducted at 10% on the said dividend by the CFC. The resident person shall be allowed to take credit of this foreign tax paid, since tax paid is lower than the tax as applicable in Pakistan at 15%. So total foreign tax credit shall be allowed. In next year, 2022, let's say attributable income is Rs 5 million, the resident person shall be required to pay Rs 750,000 in tax without any foreign tax credit, as no dividend is paid during the year and no foreign tax paid. This is how the law maintains the canon of equity and allows foreign tax paid by a taxpayer on the same income in abroad. Thank you for watching this video. This video was intended to give a summarized understanding of CFC regime under the Income Tax Ordinance 2001. If you wish to seek further clarification, you can contact us. And don't forget to follow us on our social platforms for updates regarding taxes in Pakistan.